The Reserve Bank of India's Monetary Policy Committee did not extend the loan moratorium in its policy review on August 6th, but allowed banks to restructure retail loans. On August 5th, rating agency ICRA had cautioned against the extension of loan moratorium and one-time restructuring of loans as it could pose challenges to lenders. It also said that the large restructuring could impact their financial stability. While the RBI did not extend the moratorium, it allowed the restructuring of loan for financially stressed borrowers. Previously, Finance Minister Nirmala Sitharaman had said that the government is in discussion with the central bank on restructuring to offer relief to the sector. What is loan restructuring? A one-time restructuring scheme will allow lenders to give borrowers more repayment time, reduce interest rates, take a haircut, or use a mix of measures as it involves modifying the loan terms. As a result, a borrower who is unable to honor the original loan conditions due to financial difficulties will not be declared a defaulter and the loan will not be termed a bad loan. If the loan becomes a non-performing asset, the bank will have to create a provision for it. What has RBI said on loan restructuring? The RBI had previously allowed banks and NBFCs for a one-time restructuring of loans given to micro, small and medium enterprises till December 31st, 2020. With the policy review, the central bank was expected to extend the scope of the scheme beyond MSMEs to bring relief to NBFC borrowers. As per the RBI's announcement, restructured loans will be considered a standard loan. The resolution framework will be available to only those borrowers who were repaying their loans regularly as on March 1st, 2020. Stressed borrowers will be required to get a resolution plan sanctioned before December 31st and the lender will have to implement it within 90 days. But why was the RBI wary of the decision? After the 2008 financial crisis, the RBI had laid down guidelines for corporate debt restructuring. But the restructured loans jumped from around Rs 91 crore in 2008 to Rs 771 crore in 2012. Due to the misuse of the concession, the central bank tightened the rules in 2015, which required banks to recognize restructured loans as non-performing assets. ICRA had also pointed out that it could pose implementation challenges for the lenders. But why do banks want to restructure? Top bankers had urged the RBI to approve a one-time restructuring of loans without an extension of moratorium beyond August 31st. With gross NPA levels pegged at nearly 15% by March 2021, as per RBI Financial Stability Report, top bankers believe that one-time restructuring could help brace for a big asset quality shock. During this time of economic uncertainty, MSMEs and retailers are facing a demand slump. Apart from that, borrowers might be facing job losses and pay cuts. Deferment of loan repayment in the form of a moratorium keeps the exact reason as to why a customer is opting for the scheme hidden. This could unveil a big Indian bad loan crisis at the end of the moratorium.